All right, good morning, everyone. We're going to go ahead and get started. It looks like most people have jumped on. I just want to say good morning and welcome to everyone. For those of you that don't know me, I know there are some familiar faces on the webinar today. My name is Krista Gardner. I am a partner here at SEK, and I am in our York office. I have about 15 years of experience, and I've worked my entire career exclusively with government and nonprofit clients. I do your typical audits of those entities, but then I also, on the flip side, get to provide consulting and outsource CFO services. This is really the fun part for me because I get to dig in a little bit more than we're allowed to on the audit side and really have that appreciation and understanding for what it is that you all do on your end of things in preparing for budgets and day-to-day operations and preparing for the audit, reporting to the boards, et cetera. So that's fun. I do love audits, but that is also the added fun of being able to dig in with some of my clients and do those outsourced CFO services. A little bit more about me. I live here in York. As I said, I'm in the York office. My husband, Elliot, and I have a 4-year-old son named Cohen. And then we have 3 crazy Westies at home, Samson, Oliver, and Piper. So we are an animal-loving family, but our house is a little bit of a circus most of the time. But welcome, everyone. A couple of administrative things before I jump in. I really appreciate, we had a lot of great questions that everyone submitted when registering as far as what it is that you're interested in learning. And I do not think we're going to be able to get to all of those in the hour that we have together today. And we kind of knew that going into this presentation today. So I've geared today's presentation, spending a lot of time on those accounting basics. Before we jump into anything else, making sure that we have a true understanding of the nuts and bolts of how things are recorded, why they're recorded, and what things mean. Then we'll kind of look into that financial analysis and budgeting to some extent today. But at this point, based on your feedback from today's presentation, we are considering doing a second, or at least a second, follow-up where we can dig a little bit more into some of the additional questions that everyone submitted as far as the things you're interested in. And then items like budgeting, where honestly, we could speak for hours just on budgeting. So stay tuned. That is something that we are looking to do in the next couple of months, is schedule a part 2. And again, that's just kind of based on how today goes, your feedback and questions that you may have. The presentation will be recorded. Depending on how Zoom takes, how long Zoom takes, you should get that recording in your email in about 24 hours. Also attached in that email is going to be a survey. Please give us feedback. And this is also an opportunity to give us an idea of additional topics or anything that I talk about today that you want more information on. This is really, we're looking for a way to really just kind of make it interactive. Now, with that said, we can't see each other because of the number of registrants. We had to switch over to Zoom. So we can't see each other today, but there is a chat box feature. Please use that to put in questions. I'm going to try to be monitoring that. So if you see me looking back and forth, while giving the presentation, trying to monitor any of those questions, because I would like to answer those as we go throughout the presentation. Because again, I'm really looking to make this interactive and also meaningful to those of you on the call. So again, there is that chat box. Please enter any questions that you have in there. I will try to get to those as we go through the presentation today. All right, so now let's dig in. So today is going to be all about the basics. This is really that governmental accounting 101. So hopefully for most of you, these aren't brand new topics, but these are going to be beneficial in really giving you that good understanding, that familiarity, and feeling comfortable with these topics in order to kind of take that knowledge and move forward. So how can we use that information to prepare us for the future, analyze what's going on, and really have that true understanding of what the picture of your governmental finances are. We have geared this presentation towards our townships and boroughs in Pennsylvania. There may be a couple of people on from Maryland. Hello to you. I think most of this will be pretty applicable. We will spend a little bit of time talking about the Pennsylvania DCED report. So that is specific to Pennsylvania boroughs and townships. But very familiar to as far as the, how things are presented in Maryland as well. So with that, we are going to jump in, and we're first going to talk about basis of accounting. So basis of accounting is how and when we record transactions. And I know there's a lot of information on these slides, and I'm going to try to walk through them as best as possible. I have provided some definitions on some of the slides off to the right, just in case I start saying acronyms that I forget to define, because as accountants, we like to use acronyms quite a bit. So basis of accounting, how we record our transactions and when. There are really two types, and then there's a third type that comes in that's kind of a mix. So the accrual basis of accounting, we also call this generally accepted accounting principles, or US GAAP. So this is kind of the baseline. This is what the accounting standards really say we should be using to record our transactions. And this means that revenues are recorded when earned, expenses are recorded when incurred. So it's what's considered the matching principle. So we want to make sure that any activity, the related revenue and the related expense, is happening during the same time period. We call that the matching principle. What's interesting about this is a lot of our boroughs and townships in Pennsylvania do not follow the accrual basis of accounting. You actually follow what's called the cash basis of accounting. The cash basis of accounting is revenues are recorded when actually received. So even if we were awarded a grant in November, but we don't receive the grant money until February, we don't record that revenue until February when the money was actually received. If we were on the accrual basis of accounting and we were awarded a grant in November, we would record that revenue in November, because essentially that's when it's earned. Now, with all of these slides today, there's going to be caveats and exceptions, but we're really just trying to hit the basics that really everyone is going to be experiencing. So not always a black and white picture, and it's not always going to be that exact thing. There could be some exceptions, but for the most part, that's what we're going to go with. So on the cash basis of accounting, we're not going to record our revenue until we receive the money. We're not going to record the expenses until we pay the bill. So even if we get a bill in December that we don't pay until January, on the cash basis of accounting, we record that expense in January, even though it was related to the year before. If we were on the accrual basis of accounting, we would record that bill essentially when we incurred the expense. So if we ordered, office supplies on December 15th, and essentially then they're shipped to us and we don't get them till January 2nd, we really would be recording them when we incurred the expense or we ordered them, because essentially we are now liable for that expense. So that's going to be that accrual basis of accounting. So then we have this third one, modified cash basis of accounting. This one gets a little tricky because there is no rhyme or reason usually it's not the same for everyone. So this is where an entity can combine certain elements of cash and accrual basis. And you kind of have to, it depends. You can have a cash basis organization that capitalizes assets, has capital assets on their books. And so therefore you would be modified cash basis because you add capital assets to your books. So this is kind of unique. A lot of you might be familiar with that modified cash basis of accounting term, because if there's any little bit that you're not doing as cash basis, then we call it modified cash basis. But it depends on the entity. It does not mean the same thing for everyone. And this is where it's really good to understand, okay, what is it that we're doing that's not necessarily cash basis? So again, just a reminder, cash basis, we don't record things until we receive them or until we pay them. Accrual basis, it's really based on when we earn it or when we're liable for something, when we have incurred a cost. So on the accrual basis of accounting, we're going to see things like receivables. So this means we are owed money. There is revenue we have earned that we have not yet received the cash for. We're going to have liabilities. These are expenses that have been incurred that we have not yet paid. Capital assets, one of the ones I just spoke to. This is going to be property and equipment that essentially has a useful life of more than 1 year, that we are going to, instead of expensing all in 1 year, we're going to put on our books as an asset and then depreciate those over their useful life. So the difference here is we buy a $10,000 piece of equipment, rather than it hitting the expense in that year for $10,000, it goes on the books as an asset of $10,000. And then say it's going to last 5 years, we then would depreciate it $2,000 each year for 5 years, getting to that $10,000. That's the difference there. Again, if we're cash basis, it's just going to be an expense. of $10,000 in that year. And then debt. So debt we would not carry on the books as a liability if we're cash basis. On the accrual basis, we do. So we would have a liability that's going to be for a bond, it's going to be for a note. And essentially, if we're on the accrual basis and we have that liability, when we pay principal payments, we just decrease that liability. If you're on the cash basis of accounting, we would be showing that principal payment as an expense because you don't have that liability on the books. So those are some of the big differences that we see. And what's interesting is, I'm sure there's many of you on the webinar here today that know each other. You might even have municipalities that are right beside each other, and every municipality handles this differently. It's all based on, how your accounting was originally set up, what the needs of your municipality are, what the activity of your municipality is. Do you have a bank that requires something as far as a set of financial statements that have to be on a particular basis? So everyone is different. And that's where it's really important to understand, okay, how is it that we are recording our activities? And then that allows us to kind of go forward and understand changes in our accounting and then using our financial activity to really help us prepare for the future. So of course, in the government world, we have to make everything's a little bit more complicated. So when it comes to the accrual basis of accounting, we also have something called the modified accrual basis of accounting. And we're going to get into some of the different funds here shortly in the next couple of slides. But what the modified accrual basis of accounting means is we're only going to recognize revenue when they're available and measurable, or we're only going to recognize expenditures when the liability will be paid or liquidated with current resources. I'm going to have you think of your general fund right now. And again, we're going to get into those funds here in a couple of slides. But think about the general fund when we're talking about modified accrual basis accounting, because that's really what this applies to. So if you're an entity that's on the accrual basis of accounting, your general fund uses modified accrual. And there's this, they call it a 60-day rule. And that's how you really determine if something's available or current. So essentially that gives you 60 days after year end to determine, like, yes, we were owed money, we received it within 60 days. So we're going to go ahead and record that as a revenue. If it was received after 60 days, then we have to have some other considerations about how to show that. This is a little bit different than our thought process when we're budgeting, because a lot of times we're thinking of our budget on a cash in, cash out basis, which we'll get to that in a little bit. But this is kind of that wonky thing. For the most part, the day-to-day transactions and activities that you're dealing with and looking at are not going to be impacted by this. A lot of this is going to be year end, where we're determining any accruals that need to be done, anything that needs to be recorded back into the previous year that hadn't been received yet or hadn't been paid. So again, we could spend hours digging into the details of a accrual basis and a modified accrual basis, but just want to throw that out there to you so you understand that terminology, that there is a modifier on the accrual basis of accounting for certain funds. And we'll touch on that when we get through the funds. Some of the examples here for that modified versus the full accrual kind of go hand in hand with how cash basis, the examples that I had with cash basis. So on the modified accrual basis, our debt proceeds would be revenue as opposed to putting it on the books as a liability. Our debt payments would be expenses as opposed to putting it against the liability. And our capital asset purchases are going to be in the expenses as opposed to putting that asset on the books and then depreciating it. So that's modified accrual basis accrual. So a couple of examples of where those differ. So cash basis of accounting, I am willing to guess that a lot of you on the call follow cash basis or modified cash basis of accounting, or at least that's how your day-to-day operations most likely work. So cash basis of accounting, you're going to have cash accounts. You're going to have revenues and expenses, but remember, those are receipts and disbursements. So that means we actually receipt the money and we actually disperse the money. That's when we're recording things. We're not going to see receivables. We're not going to see liabilities. We're not going to see capital assets, and we're not going to see debt. Remember that modified cash basis is then a various combinations of those two that we've talked about. So it just kind of depends on your entity and what you in the past have been doing. Now, that doesn't mean that you can make changes. Really, it's frowned upon to be changing your basis of accounting often. Usually we don't see it happen very often at all, but it can happen. There could be a change in how you decide to report your transactions, and all of that would be disclosed if you do make a change in your basis of accounting. But it's definitely not something that you want to see every year you're switching. I would say it's a once in a, 25-year thing that might happen where your basis of accounting changes, but typically you want to be consistent. And that's going to help you with also when you're looking back and looking forward and planning to really be able to compare apples to apples, as opposed to if you had different basis of accounting, it would be different. All right, so we talked about how and when we're recording our transactions. So now we're going to jump into the funds. And so in the government world, we account for resources and their related activity in separate funds. So I already talked about the general fund. That's the one we all have. But essentially, we need to remember that our funds are self-balancing, meaning they should always stay in balance. So we kind of have to think of our funds as little mini businesses. And essentially, all of the activity in each fund really needs to balance itself out. We'll talk a little bit about that in some journal entry examples when we talk about some interfund transactions. But we want to make sure that each fund can stand alone on its own and balances at the end of the day. Some funds are required by law. There can be other funds that your entity might elect to have just based on the activity that you might have going on. One of the perfect examples of this is ARPA funds. So we did have a good amount of municipalities create a separate ARPA fund. And we'll talk about this as what type of fund that would be. But essentially, there were others that just kept it in the general fund. So that was an option where it could be handled both ways. You could keep all of the activity in your general fund, or you could set up a completely separate ARPA fund. So that's an example of how you can elect to have different funds, but other funds are going to be legally required to be separate from your general funds. So let's talk about the types of funds. So the biggest type of fund that we're dealing with are governmental funds. A couple of examples here of what you're going to often see. Obviously, that general fund. This is the main fund of your municipality. It accounts for all those general programs and services. Here's where you're going to have administration, and you're going to have public safety, which can be police and fire. You're going to have streets. You're going to have streets and public works. You're going to have recreation. All of those kind of normal governmental services that are provided to the residents of your municipality. So we pretty much all have a general fund. We then have what's called special revenue funds. And special revenue funds are specific revenue sources that are legally restricted for a specific purpose. So this is where we're going to have liquid fuels funds or highway aid funds. Everyone kind of uses a different terminology, but that state liquid fuel fund that we get from gas taxes that come down for road work. So a lot of us on this call probably have a liquid fuels fund, and that is separate. That's a governmental fund, but a special revenue fund. So that's a subcategory of a governmental fund. If you were one of those municipalities that created a separate ARPA fund, it falls under here as a special revenue fund because it's a special restricted revenue that your municipality got that is legally restricted to a specific purpose. Other examples of special revenue funds are going to be a fire tax fund or a street assessment fund. Those are all, again, it's related to a restricted revenue coming in that has a specific purpose. Another common one then is our capital projects funds. And these are really going to be related to tracking resources for the acquisition and construction of major capital facilities, purchases, etc. So this is where you might be saving up money for a new building, or you're putting money aside each year for vehicles because you know every 3 years you've got to replace a vehicle. Or if you have a police force, you might be replacing vehicles every year. Even with your public works crew, you might have big pieces of equipment or vehicles that essentially need to be replaced. So this is where you are essentially saving up money for those big kind of capital projects fund activity items. So that could be acquisition or construction of different items. And usually, I say usually, your municipality is going to have kind of a threshold or a like time period that you're saving up for. So I always encourage people to have a 5-year plan. What do you know in the next 5 years that you need to be purchasing or saving up for? And that's kind of how we can develop how much should be going into that capital projects fund each year in order to meet those goals. But every municipality handles this differently. Some don't have a capital projects fund. Some have multiple capital projects funds, depending on if you're doing a whole new building project, you could create a fund just for that building project. So it really just, this is where you have a little bit of wiggle room in how you can account for those items. But the one thing to remember is essentially when funds are transferred or moved to a capital projects fund, they really can't be moved back out. And that's really keeping us from moving money and kind of keeping it there and then saying, well, we're going to just move it back and now we're going to use it for operations. Technically, at the end of the day, if there is a need for operations, you can move money out, but it's kind of frowned upon and there is a process to go through. So really kind of the golden rule here is to think about capital projects funds as we have a specific need for them, or we're planning for something in the future. And that's why we're putting this amount of money into the capital project fund to be used. It's better to do that than to kind of just say, well, every year we're going to put a certain amount of money in without a plan. And I always just encourage that because at the end of the day, if someone comes to one of our public meetings and starts asking questions, then we have a story. We have a reason for why that money's been moved, what it's going to be used for. And that just helps us in being able to answer those kind of questions that might come up. And that does happen. That definitely does happen. Two other types of funds for governmental funds that we don't see a lot are going to be debt service funds and permanent funds. I didn't want to ignore them. But I think in our world here, those of you on the webinar, we don't see them a lot, but they are out there. So you could have a specific debt service fund for the payment of principal and interest on debt. And then you could also have a permanent fund, and that's really it's a restricted amount of money. And so really this could be maybe you have a cemetery that you are responsible for the upkeep on, and that's somewhere, previous times someone gave, $50,000 to be permanently kind of restricted for that cemetery. So that original $50,000 is really restricted and can't be used, but there's money that's made on whatever that's invested in each year that can then be used towards that upkeep. So it's kind of like an endowment if you're familiar with more of a nonprofit world with endowments, but that's what a permanent fund is. The core money that was originally given is permanent and can't be spent, but that money can make additional money, which then is used for the upkeep or the purpose of whatever that was set up for. So after governmental funds, we come to proprietary funds, and proprietary funds are truly like little businesses. These enterprise funds are really what everyone here is going to be familiar with. Those are going to be your water funds, your sewer funds, and that's any activity for which a fee is charged to external users for goods and services. So again, sewer and water, that is, those again have to stand alone. We often can't be taking sewer fund money and be using it for general operations. Same thing with water funds. If we have sewer and water funds, they really need to be kept separate because you might not have the same customers getting sewer and water services. So that's where these need to be kept separate. They're thought of as mini businesses because it is a charge for service. And then obviously there are the related expenses that go along with those enterprise funds. But usually, like I said, sewer and water funds are the ones that we're going to run into quite often. There is another type of fund, not going to spend a lot of time on it because I feel like those of us on the webinar here probably don't see it often, but there are internal service funds that are also proprietary funds. Again, operating is that kind of business, but it's more for providing goods and services to other funds or component units or other governments on kind of a cost reimbursement basis. Again, we usually don't run into that too often, but that's not saying that someone on here doesn't have an internal service fund. And then the last type of fund is what's called a fiduciary fund. So this is where the government, your municipality, might be a custodian of funds, but they can't be used for general operations. So a lot of times this is going to be like a pension plan or some kind of trust fund, where essentially the fund is still reported under the governmental entity, but it is completely just in a custodial nature, meaning the municipality has kind of the oversight of that fund, but it cannot be used towards operations of the government. It is for, with the example of a pension fund, it is truly for that pension plan. So it kind of depends on your municipality and what kind of pension plans you have set up, who you have them through, whether or not you might be reporting a fiduciary fund. If you're getting reports And if you're including that on your DCD report each year, again, this is completely separate, can't be used for operations, but there's that kind of custodial responsibility by the government to make sure that those funds are handled correctly. All right. So I'm going to circle back to my comment on basis of accounting and the different funds. So the first thing to note is that your basis of accounting should be the same across all funds. So I'm going to skip to the bottom section here. If you are a cash basis municipality or a modified cash basis municipality, you are modified cash or cash basis for all of your funds. So if you have a general fund, a liquid fuels fund, a capital projects fund, and a sewer fund, you are cash basis or modified cash basis for all of those funds. Same thing with the accrual basis. Now here's where that little wonky item comes into play. If you are accrual basis as a municipality, your governmental funds are modified accrual basis, and then your proprietary and fiduciary funds are full accrual basis. Governmental funds, reminder, that's general fund, capital projects, liquid fuels. That's modified accrual basis. That's that whole current resources measurement thing, where essentially we're still operating on that accrual basis. We have receivables and payables, but they need to be what's called available or current resources. But when we get to our proprietary and fiduciary funds, so a sewer or water fund, or even some of those pension kind of trust funds, those are that accrual basis. So we don't need to factor in that current resources item. There's a lot that kind of open a can of worms on that, as far as I think we could spend 8 hours talking about the difference between modified accrual and accrual. But again, just to kind of throw that out there so you have an understanding of, the differences in how those funds operate. Alrighty here. There we go. Okay, so now that we understand our funds and how we record our transactions, interfund activity is probably one of the things that I talk about the most, and it can get confusing. And so I wanted to spend some time to talk about due to, due froms, and then transfers. So we are first going to spend our time talking about due to, due from transactions. So these are interfund loans that will be paid back. Something is due to someone. Something is due from someone. Now, obviously, someone is a fund in this case, whether it's general fund, sewer fund, capital projects, etc. So what happens is those due to, due from accounts accumulate all of those transactions that are owed back and forth until the cash is transferred, and then we wipe it out. It's kind of like if you had a ledger and you're sitting there like, okay, they owe me this, they owe me this, they owe me this. It just accumulates into the point where, oh, okay, they paid me for those items. We're going to wipe those out. So the best way to look at this is an example. So one that I think probably we often find in most of our municipalities of all sizes is paying of bills and splitting those bills between funds. So here's my example. The general fund pays the electric bill of $100 on March 1st. The sewer fund portion of the bill is $25. General fund pays it, but sewer fund really owes a portion of it. The sewer fund then reimburses the general fund on March 15th. So here's what the transactions look like. Top section here is March 1st. So the general fund is going to pay the bill. That's where we see the credit of $100. We know the general fund paid the bill. So $100 comes out of the general fund checking account. The other side of that then is usually the expense. Okay, what did we pay for? Well, in this instance, $75 is the general fund expense. So you can see I have that there as a general fund electricity expense account of $75. So we've hit our expenses by 75. But we have this $25 that is not the general fund's expense and is owed to us. And that's where we record it as a due from sewer account. So as you can see there, our entry balances, so that's Accounting Basics 101, not just Governmental Accounting Basics. Accounting Basics 101 is our entry needs to always balance. We can't have an unbalanced entry. The other thing that we'll point out, we talked about how funds need to be self-balancing. We always need to make sure that our funds also balance. So as you can see here, we have 3 line items that are all general fund. So our debits and credits equal $100, and then our general fund also it's all general fund in those 3 transactions. So then we're going to jump down to the sewer fund line. And you can see on the sewer fund on March 1st, we're going to record $25 towards our electricity expense, because at that time, there was an expense on our sewer fund for electricity. The other side of that then is due to general fund account, because we owe the general fund $25. We didn't pay the $25, we owe someone. And in this case, we owe the general fund. So in the top half, you can see the yellow general fund due from sewer fund account offsets the blue sewer fund due to general fund account. And I know the funds and the due to due froms can get very confusing. So again, it's kind of taking that step back and literally thinking about who owes who money. So general fund, it's due from sewer. Sewer fund, it's due to general. So at this point on March 1st, the bill was paid, $100 came out. The expenses have been appropriately recorded. $75 of expenses on the general fund, $25 of expenses on the sewer fund. And we have this open item where sewer fund owes the general fund. So now we go to March 15th, the bottom half here. And now we're going to actually pay that money back. So what happens in the top portion is $25 goes into the general fund checking account. And then the due from sewer fund account is cleared out. So the 2 yellow lines, you can see we had $25 in it at the top, and now we've taken $25 out of it. So we are no longer on the general fund owed money from sewer fund. It has been paid back. And then the bottom piece is the sewer fund. So $25 came out of the sewer fund's checking account, and then we wipe out that due to general fund. So that's where I've kind of shown we want to make sure that everything's in balance. The due to due froms, the yellow ones clear themselves out, and the due to due froms, the blue ones clear themselves out. Because essentially at that point, there's no longer any money owed between these 2 funds. Now, I know this is one transaction, and there are some of your municipalities out there that, I mean, every month you've got a whole slew of transactions that are owed between general fund and sewer fund, or even owed between a stormwater fund and general fund, or vice versa on any of the different funds, depending on how you receive money and how you pay the bills. There also might be some of you that get separate bills and you don't need to worry about it, or you enter your bills separately. So it is possible that you get this $100 bill from the electric company and you enter a $75 bill for general fund and a $25 bill for sewer fund. The electric company still gets their $100. You're just operating differently there. But this is one of the biggest items I think I talk about often or get questions on. Also, kind of the trip up that ends up happening is, say on March 1st, we do that top portion correctly, where we paid the $100 bill, we hit our expenses for 75, and we say due from sewer fund account of 25. But we forget to do the sewer fund account, because that literally is just us doing a journal entry to say, hey, we owe this money. So the trip up that happens there is when the sewer fund pays it back, it's then hitting an expense and it's on the sewer fund side and it's not coming out of the due from on general fund side. And so that's where it can get a little wonky, is we end up having things in due to due froms on one fund, but not on the other. So that's where it's really important to kind of think through the whole transaction. Obviously, in order to pay the bill, we didn't need to record the sewer fund line items, but obviously that is the other piece or the other side of the equation. So just kind of a reminder there to be thinking about that. If you do have expenses that go across funds, really thinking about how is it that you're paying those bills. And this comes up in payroll a lot. Now, those of you that do payroll through a third party provider, you might have it already set up with them where they are splitting out these entries for you, which is awesome. Sometimes they work, sometimes they don't. We can have some issues there, especially when you have things that change from payroll to payroll. But again, just wanted to go through that for a true understanding of the interfund activity. So now on the flip side, we're going to go to transfers. So that's the other thing that can get confusing when it comes to having due to due from activity and transfer activity. Due to due froms are a loan. Something's going to be paid back. A transfer just means we are moving money from one fund to the other. One fund is giving money to another fund. An example of this that we see often is going to be if in your general fund budget, you included a transfer to capital projects. So what I've picked here is $500,000. So I said you have budgeted for $500,000 to be moved to the capital projects fund towards a new building. So this is, again, one of those things where we're planning ahead. We know in 3 years, we're going to be doing a new building, and we're trying to fund that with some of our general fund money, and maybe you have to go out for a loan too. But essentially, if you have money on hand that you can put towards that project, maybe you're transferring in there each year in order to help pay for that project. So here's the example. We transferred the money on April 15th, $500,000 from general fund to capital projects. This is what those entries look like. This is more simple than the due to, due from. This is a one-time item. We do not need to record anything until we actually transferred the money. So on April 15th, in the top blue line, we see $500,000 comes out of the checking account for the general fund. The other side of that, the quote unquote expense, not really an expense, but that's how we can think about it. The expense is a transfer to capital projects fund. Now in Pennsylvania, when we follow DCED, typically that DCED code is going to be 492. So transfer to another fund is going to be a 492 account. So on the general fund, we have taken 500,000 out of our checking account and we have moved it to capital projects. So 500,000 comes out of the checking account, 500,000 is booked to the 492 in most cases, transferred to capital projects fund. On the other side, capital projects fund, we now have $500,000 coming into our checking account. And then the other side of that is a transfer from the general fund. So our transfers out are usually 492 accounts, our transfers in are 392 accounts. And that's just because our revenues per DCED chart of accounts are in the 300s. So this is money coming in. So it's not really a revenue, it's a transfer, but it's still in that 300 series. So it's 392. And then expenses are our 400 series. So again, it's not a true expense, it's a transfer, but it's in that 400 series of a 492. So what I've pointed out here is the blue lines are the bank accounts, money going from one bank account to another. The green lines are the transfers, money being transferred from one fund to another. In both these scenarios here, you can see that the debits and credits balance, the activity in each fund balances. We always need to make sure that our debits and credits match in total, but then also by fund, because then we can have out of balance funds. And that can be a difficult thing to unravel depending on how far that goes along. So again, just a pointer here to make sure that when we're doing these transactions, that everything is in balance and our transfers out, our transfers in should always net to zero. So at the end of the year, if we've done transfers, the total transfers in across all funds really should net to zero with all the transfers out to funds if we've done them correctly. And that honestly is the same thing with those due to, due froms. So at the end of the year, if there is money owed between the funds, your total due from accounts should equal your total due to accounts at the end of the year. If they do not equal, that means something was done incorrectly. A wrong amount, a wrong fund, or only one side of the transaction was done correctly. That is both of those items on the DCED report are year-end items that we need to look at to make sure all of those due to, due froms net to zero and all of those transfers in and transfers out net to zero. So that is something that is required and must essentially happen in order to file that report. So hopefully I didn't lose anyone there as far as the interfund activity, but that is something that we get asked about a lot and we spend a lot of time discussing. So I wanted to kind of talk about that. The other hot topic item that we talk about is fund balance. It's a word that's used a lot, but I feel like often is used to mean cash. So I want to talk about what truly is fund balance. So fund balance is our assets minus our liabilities. Now, if we are a cash basis entity, fund balance might equal cash. If all we have is cash accounts, then our fund balance most likely will equal cash. But if you are an entity that's even modified cash or accrual basis, there are going to be other elements in here. And so that's where you're going to have your total assets minus your total liabilities is going to be fund balance. So you could have a cash balance of $100,000, but then you might have some payroll liabilities on the books of $10,000. Now I'm just rounding numbers for ease here, but essentially if we had $100,000 in cash accounts, $10,000 in payroll liabilities, well then our fund balance is $90,000. So as you can see, their fund balance does not necessarily equal cash. But a lot of times I feel like that is kind of something that gets confusing where we're thinking of fund balance as cash. So again, that's where it's important to understand, how do you operate? What's your basis of accounting? How are you recording transactions? And also, what fund are we talking about? Because the funds can operate a little bit differently, as we saw, especially if you're on the accrual basis of accounting. I'm not going to spend a lot of time on talking about full financial statements. So today we're really focused on the DCED report, because we all have that in common. But there are many of you that probably get those full financial statements that look different from the DCD report and have lots of footnotes attached to them. This is where we start to talk about the categories of fund balance. So on the DCD report, as we'll see in a minute here, it's not broken out by category, but also good to understand, yes, you might have fund balance of $100,000 or $3 million or whatever it is for your municipality. Not all fund balance can be used the same. So you do have to be understanding of what goes into that fund balance. Are there items that can't be spent? Are there items that are restricted by an outside party? So if you have bond funds on hand where you've taken out a loan to be used to build a building, that money's restricted for building that building. Are there committed amounts? Meaning this is typically where your board has made a determination to commit funds for something. Now that can change by another board action, but essentially this is like earmarking by the board. So there could be amounts that have been committed for future purposes. There's also assigned amounts. Depending on your municipality's fund balance policy, this is usually meaning that management can earmark funds. So this is where you might know that in the next couple of years, you're going to have increased healthcare costs. So you're going to start to put some money aside, or there's something else that you're earmarking funds for. Again, this is not split out on the DCD report, but something to be thinking about when you're understanding what makes up our fund balance. What can we use these funds for? Everything else then is unassigned. So that means it's not restricted in any manner. It hasn't been committed. It can be spent. It can really pay the operations of the municipality. Two things I want to point out here. If your municipality is going into your next year's budget planning to use fund balance, that essentially means that you've assigned part of your year-end fund balance. So say at December 31, 22, you knew that you were going to use $300,000 of your fund balance for 2023's budget. So now you've assigned part of your fund balance because you said, you know what, 300,000 of this we're going to use to balance the budget in 23. So again, that's where we've earmarked funds. The other thing too is we do have municipalities that have kind of fund balance reserve policies. So that might look like we want to have 3 months or we want to have 6 months of general fund reserves, meaning we want to, based on an average of our general fund expenses, have money set aside in case something happens. A lot of us are dependent on revenues that are cyclical. So we got a lot of tax revenue that comes in at the beginning of the year. So as the end of the year comes along, obviously our revenue streams start to die down. We didn't know a big pandemic was going to happen a couple of years ago. There might be, other delays in state funding or even federal funding that can come through that affects us. So a lot of municipalities have elected to have this kind of fund balance reserve just in case something happens or to make sure you have money on hand to pay the bills. This would be another example of something being assigned or committed, kind of depending on how you've come up with that policy. But again, knowing that, hey, you might have fund balance of $100,000, but we want to have a reserve at all times of $50,000. So kind of when you're thinking about the future, you want to back that $50,000 out. That doesn't mean we ignore it and we hide it. It's still there because it can be used if need be, but also kind of making sure that we're following our policy that essentially says we want to have, X number of months or X number of dollars always on reserve in case we need it. So just a couple of things to point out there on fund balance. I get asked about fund balance all the time. This often is a hot topic item with our boards. And again, it just takes a little bit of understanding and some training and making sure that everyone is saying the same thing or speaking the same language, because again, sometimes we interpret things differently. And that's kind of the overarching theme of this presentation is, before we get too far down the road, let's make sure we all have a good understanding of what the basics are, kind of what that baseline is of what our governmental accounting and financials mean. Okay, so with that, I know we've covered a lot of time already. I would like to at least get through a little bit of an overview of the DCED reports. Again, trying to cover questions that came in. I knew it was going to be hard to get through everything today. So hopefully I think it'll be a good opportunity for us to do this on a more routine basis. But I do want to spend some time before 11 here talking about the DCD reports. We all have the DCD reports in common. They're required for all of our boroughs and townships in Pennsylvania. What I have done here is brought in just some screenshots of the report. I'm not going to hit on every page of the report because there is a lot, but I want to touch on the main pieces here and how to read these, because this is something that I think can cause some confusion, especially if we're used to seeing reports run out of your system, whatever that system is, if it's QuickBooks or if it's a Munis or another type of governmental accounting system. Those reports don't often look like this, but they truly are based on each other. So this is where it comes back to DCED and the chart of accounts. So there is a chart of accounts out there that this DCED report follows and really is the baseline for how our accounts should be set up in our municipalities in Pennsylvania. What we're looking at here is the balance sheet. And you can see this is just a snip from the 2022 DCED report that was sent to everyone. And on the balance sheet here, you can see there are 2 pages, and they really are side by side. There's an extra little line on the second page. I couldn't quite line them up there to have that last line there at the bottom. But as you can see, when you're going left to right, it breaks down your funds. So the left-hand page is all those governmental funds that we talked about. So I'm sure everyone's used to looking at that general fund column. This is what we live by. This is our general fund. We know this. That second column then is special revenue. So here's where things can get a little tricky, because if you have multiple special revenue funds, this is going to be the total of those funds. So if you have a liquid fuels fund and you have a fire tax fund, then the total of those 2 goes in this column. And that's where it can be difficult when you're looking at your reports and looking at the DCD report. It's not necessarily going to match up because you need to know what to accumulate or total for these columns. Your third column is capital projects. Most of the time, you're only going to have 1 fund here, but it is a possibility that you would have more than 1 capital projects fund. And then the fourth column being debt service. Again, this is not something that I think most of us on this call see. On the right-hand side, we then continue kind of across the balance sheet. So the next section is those proprietary funds that we talked about. So the left-hand column is enterprise funds. That's going to be your sewer fund, your water fund. Again, you might just have a sewer fund, so that column is going to match up with what you know. But if you have a sewer fund and a water fund, or even a stormwater fund, it might be a combination of all 3 of those that are being reported in this column. So again, having an understanding of how do we take your information that you're looking at and how that goes into the DCD report. There is the internal service fund as well that we talked about. Fiduciary fund. This is your trust and agency fund. So again, these are going to be those like pension type funds that your municipality might have and might report. You just have a fiduciary responsibility, but they still might get reported on your DCD report. I'm going to, for now, skip the account group section. That'll be for another day. And then you can see the total on the very right-hand side. And so that is truly going to be the total of all the funds from left to right across for your municipality. You can see this is set up in the top box being your assets. So that top line is where, especially if you're a modified cash or cash basis entity, cash and investments is probably going to be one of the only things on here that you have. But if you are on that accrual/modified accrual basis, you might have some of these other things in here that have, taxes receivable, accounts receivable. We then have the due from other funds. So if you could be a modified cash basis and have due from other funds there. And then there's some other items that don't get used a lot in that asset section. The second section then is your liabilities. So here's where you're going to have some of those payroll taxes, other current liabilities like accounts payable, due to other funds, long-term liabilities, etc. And then the last piece, the last box at the bottom is fund balance. Now, there are 4 line items here, but for the most part, that third line item that just says fund balance is typically what you're going to be seeing on your DCD reports. There are situations where you might use others, but for the most part, everyone here is going to be using that fund balance line item on 3. So again, This is the accounting equation, assets minus liabilities equal our fund balance. And then that just goes straight across the balance sheet, totals, and essentially that's where that extra box is. That's our total liabilities and fund balance that then ties to total assets. So a couple of the triggers in DCD is those due from other accounts, that total needs to match the due to other funds line item. So that's something it will kick out if that doesn't match. And that's also part of an audit process that we're looking at when we're auditing municipalities. And then also the same thing where assets need to equal your liabilities plus your fund balance. So those are a couple of things on the DCD report that if they don't match, it will get kicked out. So then not the last part, but the other part of the DCD report that I wanted to hit on are the revenues and the expenses. So same thing, you can see it shows our governmental funds, proprietary funds, fiduciary fund, and total. I just pulled in a snapshot from both the revenue section and the expense section. And this is to just show on the DCD report, your revenues are split out by type. So you can see the first box is taxes. And then you've got real estate tax, occupation tax, and so forth. You can see 301 real estate tax. So probably almost all of you, your real estate tax account starts with 301. You might have 2 digits after it. You might have 3 digits after it. For the most part, that is just based on how you set up your accounts. And maybe not you, it could have been someone 50 years ago. But essentially that is the basis for what's required is those first 3 digits. Now, sometimes you'll see like real estate transfer tax are going to be 310.10. You might have it as 310.100 if you do 3 digits after that. But just to kind of show that those account numbers didn't really come from just out of nowhere. They really should be based on DCED. What's important here is that DCED uses all of this information to provide publicly, these are what municipalities are getting as far as taxes or licenses and permits, fines and forfeits. So all of this information is public. It's usually about a year behind on the DCED website, but you can go in and pull anybody's DCED at any point from the state of Pennsylvania. So something also to be thinking about, because when people are comparing, obviously we want to make sure that we're getting the revenues in the right bucket. Also, tax revenue is going to be heavily used in the general fund, but we're not going to see any of that in your enterprise funds because your sewer, water, stormwater funds are not going to have tax revenue. So although they're there, there's that column, that doesn't mean that you're going to have things in those buckets. It's going to be down lower where there's going to be service revenue that you would see those kind of revenues. So again, DCED for all of us is really showing our revenue types, taxes, license and permits, fines and forfeits, etc. And then it's the same thing on our expenses. So we have general government expenses, we've got public safety expenses, public works, and so forth, recreation, they're all different categories. So pretty much everybody in Pennsylvania, if you have police expenses, should be using 410. If you have fire expenses, should be using 411, and so forth. I will say in the general government section, sometimes it's up for interpretation. Well, does it go in secretary clerk? Does it go in general government? Does it go in other administration? That is really going to be different from municipality to municipality. It's not always consistent, but that is where it is important to understand how has your municipality been entering your transactions? How have you been recording the data? Does it make sense? And then trying to be consistent. Because if we start to compare things year over year and we're not being consistent on what buckets we're putting them in, that's going to be really difficult for us to then interpret that information and use it going forward. So that's really the main thing here is how do we figuring out how it is our municipality is recording this information to then go from, okay, does it make sense? Should we make a change? But then I will caution you, when you start to make changes to how you're recording your transactions, document that somehow, because then obviously when you're going back different years and you do make a change, that can be, it's something you want to know if you're looking at different trend analysis or understanding why one expense is much higher than it was in the past. Well, it's because you've moved things around. So definitely making sure that you document that and then communicate that. If there's a whole team of individuals at your municipality that are coding invoices, creating the budget, entering transactions, making sure that's consistent, where if we budgeted for electric to go in this account, that we're actually coding it to go in that account and it's being entered into that account. So making sure that everyone's on the same page as far as where things should be entered. So we are at 10:58. I am going to pause there. I know I have thrown a lot of information at you, and it's really just scratching the surface. I'll kind of pause here to see if there are any questions that anyone has for today. And then again, please let us know if this information was helpful, what other topics. There's a whole section on financial analysis and budgeting that I knew we wouldn't get to today. I think there were a lot of questions sent in on budgeting. So that's, I think, an area where we want to spend some time maybe in a separate session working through. But what are the other topics that you're looking for? What was helpful to you? So we can kind of continue to have these conversations and make them meaningful. So I will pause there and just see if there's any other questions that come through. Otherwise, I really thank everyone for joining us today and hope to see you soon. Thanks, everyone.